Welcome to County Portal, your simple source for local government services and public records. Let's get started.
We're tackling a difficult question today. What happens if you don't file a final tax return for a deceased person, especially when it seems like they had no estate? It's a situation many people face, and the answer isn't as simple as you might think, because no estate to you might not mean no tax obligation to the IRS. The first thing to understand is that a person's tax-paying life doesn't end the moment they pass away. A final tax return, a Form 1040, still needs to be filed for the year of their death, covering the period from January 1st up to the date they died. The real question is whether a return is legally required. The IRS has specific income thresholds for filing, based on factors like age, filing status, and gross income. So, the first step is always to figure out the deceased person's total income for that final, partial year. If their income was above the filing threshold, a return must be filed, regardless of whether there's a formal estate going through probate court. But what if you just don't do it? Let's break down the two main scenarios. Scenario 1, a refund is due. This is the most common situation, especially for retirees or those who had taxes withheld from paychecks. If you don't file the final return, you simply forfeit that refund. The U.S. Treasury keeps the money, and that's the end of it. You're leaving money on the table that could have gone to heirs or paid final expenses. Scenario 2 is more serious. Taxes are owed. If you fail to file when taxes are due, the IRS will eventually catch on. They receive copies of the same W-2s and 1099s that you do. They will create what's called a substitute for return, calculate the tax owed in the least favorable way possible, and then add on hefty penalties for failure to file and failure to pay, plus compounding interest. The IRS will then try to collect this debt. Now, here's where the no estate part gets tricky. If there are truly zero assets, no bank accounts, no property, nothing of value, then the tax debt might become uncollectible. The IRS can't get money that doesn't exist. However, if the deceased person had assets that passed to someone outside of probate, like a joint bank account that went to the surviving owner, or a life insurance policy with a named beneficiary, the IRS can potentially hold the person who received those assets liable for the unpaid taxes, up to the value of the assets they received. This is known as transferee liability. The responsibility for filing typically falls to the executor or administrator of the estate. If there isn't one, a surviving spouse or another person in charge of the decedent's property is expected to handle it. For a surviving spouse, if they were filing jointly, they are held jointly and severally liable, meaning they are 100% responsible for the entire tax bill anyway. The bottom line is that ignoring a final tax return is a gamble. You could be giving up a refund or inviting the IRS to pursue a tax debt with added penalties and interest from anyone who received the decedent's assets. It is always the best practice to gather the financial documents and file that final return to properly close out the deceased's affairs with the government. Thanks so much for watching. I know this is a tough topic, and I hope this cleared things up. If this video was helpful, please give it a thumbs up and consider subscribing to the channel for more straightforward answers to your financial questions. See you next time.